Hey everyone, welcome to our overview of the S Corporation. For those of you that are just chugging along here, want to acknowledge you for just absorbing all this tax stuff. So we here want to talk about when an S Corporation makes sense, right? Go through the same questions. What is it? How does it benefit you? This one's going to be a little more straightforward. I think that recommendations of an S Corp are really going to make sense based on income. And oftentimes, this is a conversation where you're already a hell yes on setting up an entity, right? So, for those of you that watch the entity video and are like, I don't know if I'm going to set up an entity, maybe an S Corp will put me over, I wouldn't say so, right? I think that this is more for folks that really want to commit to an entity and then on top of that, want to grow their business big enough that an S corporation makes sense. An S corporation makes sense at a certain size, and it's not a small size. It is for some businesses, but oftentimes we're talking to owners one on one, and we'll kind of go through that. But just again, just to recap what we might have seen in the first video, there are different kinds of entities, right? There is the C corporation, which is a standalone entity, and then we have these structures that are pass-throughs, right? The partnership we kind of covered as a part of the LLC. That can get really technical tax-wise, but for the purpose of deciding what entity makes the most sense, it's just not going to factor in. So we're here going to focus on the S corp, and the big highlight, if you did read the tax considerations, right? An LLC pays self-employment tax on all income. An S corporation is going to pay self-employment tax only on salary, and then any income above that is going to be self-employment tax-free, right? So what's the kicker there? You've got to have a salary. So we've had clients that signed up as S corporations who don't salary themselves. Say, look, we'll file this for you because we're basically taking your files and reporting them on a tax return and filing them with the IRS, as is our job. But I'm going to warn you that not having a salary is going to be a red flag. And what that means is when you have a salary, when you do payroll, you're filing what are called payroll reports. You're filing quarterly payroll tax returns, called 940s and 941s, right? So those are the ones that matter from a tax perspective. And those are things that get filed when you have a provider like ADP or Gusto or Paychex. So there are a few different payroll providers that provide that service. We don't. It's too small of a task that a payroll provider should do. So we usually recommend that if you were going to have an S corp, you have some kind of quarterly filings on file through Augusto, through a Paychex, through those payroll providers. So just be cautious of that. That we have had cases. It doesn't happen in year one, it doesn't happen in year two. It usually happens year three, year four, where you get a letter that say, "Hey, we have your tax returns, but we don't have 940s on file, right? We don't have the payroll taxes." So that's going to be a red flag. It's going to automatically be apparent. So just know, what am I trying to say here? Why am I spending all this time talking about payroll? Like I'm trying to talk about S corps. You're going to have a requirement to pay yourself something, and you can't just transfer it from your business account to your personal. It's got to be run a certain way, right? So first of all, if you didn't like the requirements of an LLC, you're not going to like a lot of the ones for the S corp. But stay tuned, it might really make sense for you. So first I'm going to talk about just what the S corporation is. The S stands for small, right? So it is intended for the small business owner. Oftentimes these are single person businesses. We have clients where they have four in the S corporation and they all have to be payrolled. And it's to provide a relief on taxes, right? So this is literally Congress telling you, bipartisan bill, them saying, look, we think this is good for business owners, right? Capitalistic society, we want there to be some carrots and some sticks, but we want there to be a carrot to relieve the taxpayer of self-employment tax on their income, right? So again, this applies to income, which is revenues less expenses. That remaining amount is your income. That amount is not going to be taxed with self-employment tax, right? So it's a big difference. The gap can be 15%, especially if you just have an S corporation. This is your only income, and it's something like 100K. you can look at the model and we'll show a comparison of what the tax savings are, where you're saving tens of thousands of dollars by electing to be an S corporation. And for some of you clients watching, we did that for you, and I'm going to take that imaginary thank you here on this call here. But the point is, there is a massive tax savings that we'll talk about. An LLC or a C corporation can elect to be taxed as an S corp. For purposes of us, we're just talking about LLCs taxed as an S corp, but you can also have a C corporation, a professional corporation, with an S corp designation. The point there being that an S corporation is a status with the IRS. It is not a formal entity. So for folks that say, I have an LLC, I need to set up a new entity that's an S corporation. No, you don't. There might be reasons to do that, but you just need to get S corp designation with the IRS. There are rules around that. I'm going to talk on this briefly, but we're also going to send out our S corp webinar, and that webinar covers actually how to set it up, what the specific requirements are, when you can file to be an S corp. Not going to cover that here. We're just going to talk about what an S corp is and what the benefit, right? So we've already talked about it being a pass-through entity. Taxes are paid at the individual level, which is different than a C corporation, which pays it as a corporation, and then you pay it as an individual. So be clear about that distinction. We're talking about taxes saved at the individual level. So what are some requirements of an S corp, right? So you can't have more than 100 investors. So that just means if you're trying to set up a company that picks up funding down the road, can't be an S corp. One class of stock, again, kind of same concept, right? Preferred versus common. Doesn't apply, but not a lot of folks coming through our doors are trying to do that. All shareholders must be U.S. citizens or official residents. So that's a big sticking point for clients who are here from abroad. You need to be official here in the U.S. to do it. So that's one point. And then the last point, we've talked about this, going to hit it home again, you've got to run payroll as an S corporation. So you might be thinking, Miguel, you just talked about everything that's bad about the S corp. Why in the world would I ever want to do this? So I'll show you in the next slide. But again, I guess I didn't know this slide was going to talk about more reasons that make the S corp difficult. But again, you want to make sure that you're payrolled and that you're payrolling something reasonable as the regulations require. That means it can't be 10K. You can't say, hey, look, okay, I'm going to payroll myself, payroll myself $1,000 or $500 a month, right? That's too low. We have a rule at our firm where we want to at least pick up at least $15,000 in payroll salary, right? Lesser of the two, or 30%, 30. Let me say 33%. I'm going to say 33% for the purpose of this call of income, right? So if you're not pegging this to comparables, meaning that you're going out in the market and you're saying, hey, I'm a property manager. I look at the national average of property managers and the salary is $40,000. That's one way to do it, right? That's reasonable. You've done a comparables analysis. But if you're not going to do that, you just want quick of thumb, it's got to at least be $15,000, or it's going to have to be 33% of your income. So if you've made 30,000, you say, oh, 33% is about 10K, minimum 15, right? So we want to make sure that we're meeting the rules, that we're not being too cute when we take advantage of this. You're still taking a benefit, right? So you're still salarying yourself 15, you're still taking the other 15 for your self-employment tax. So there's still a benefit there. You just want to make sure you don't get tripped up on those rules, right? So just make sure that you have some kind of thought process around this, something documented around this, right? And if you get it wrong in year one, not the end of the world, right? It's still exposure. You still know that it might get adjusted. But if year two you get it right, then we're very comfortable with that, right? So again, the big risk is that the IRS comes in and says, you know what, this salary isn't reasonable. We're going to adjust the whole thing, and you're going to get self-employment tax on everything, right? So don't be too greedy on this. Use the tax code, right? Definitely use this. Definitely leverage the tax benefit of an S corp, right? And I'll show you how you can do that. So in this example, we have revenue of 180. We wanted to choose a high enough number, and then net profit of about 90. So it's about 50% margin, and that's kind of a big key. If you're a low margin business, right, on $100 you keep 10. S corp's probably not going to be the best for you, and S corp's probably going to apply to a service business, or if you're a rental arbitrager, it's going to apply to those who have multiple properties who are making profit, tax profit, cash flowing on each single property, and there it's going to, that's going to accumulate, and that can be a relatively high margin, right? That's different than a property owner who has tons of depreciation who's got a loss. So loss companies don't do an S corp, right? This is only when you have a certain level of income where you can classify some of it as salary and then the rest as distribution, which is not subject to self-employment tax. So just be very mindful. This is an income-based election that you want to do. And as you can see in our example, if you walk through it, right, LLC taxed on 100K of income is going to have a 30% tax rate, where a S corp under that same scenario, with, you can see our wages calculation here, is going to be taxed at 22%, right? So there's a real tax savings, and you can see the total difference is about 7K. There's a real tax saving on these two scenarios, right? So make sure that you're conscious of your tax projections. If you just hit that, and I usually say, look, don't do it unless you hit the 50K net profit mark. So net profit's 50K and S corp starts sounding good, but don't do it if 50K was a breakout year and you're planning on traveling Europe next year for half the year, and taking 6 months off, and now you're going to go back down because you're still going to have a payroll requirement. Um, and you might have to payroll yourself more than your profits. So definitely be conscious of projections when you do an S corp. So typically our S corp clients are folks that are for sure 50K and up in net profit. Be mindful of that. Hopefully I've explained why. If you want to continue this conversation, I'm happy to do it. Hope you have learned something from this, and I'm looking forward to continuing the conversation with you.